All right, good morning, everybody. We're going to go ahead and get started. I think we'll have a good batch of stragglers come along, but we have a lot of material to cover today, so we're going to have to move here. You should have gotten a copy of the slide presentation last night, so you should have that to follow along if you so desire. I'm not going to go over our bios, but Steve and I are presenting. We're back with the What Next series, so you can read your bios in the meantime, decide who you like best, and we'll take a poll at the end maybe. So what we're going to do today, a couple housekeeping items. We are recording this session, so I would encourage you maybe to keep your video off. This is a Zoom meeting, it's not a webinar. I do have you chat it, but you are welcome to comment, to chat to either Steve or myself. Any questions or comments that you may have, we'll keep our eye on that through the presentation. And we'll try and take that periodically. Just a disclaimer real quick, this presentation does not include any legal advice or anything. We're going to keep this at a very conversational level today. So we're not going to go into notice numbers and, things that can get very legal and timing and stuff like that, for appeal rights and stuff. We're not going to go into all that today. We're going to try and keep this at a fairly high level and, discuss as applicable here. So here's a little bit of what we're going to cover today, which you'll see our sections. My thought is we probably may not get to everything here, but we have really a lot to cover today. I thought this would be a good presentation we could throw together without too much work and would be of value because this certainly is a hot topic, but I greatly underestimated the amount of material that we could speak about on this topic. But just hats off to you because you're tuning in to listen to CPAs talk about what CPAs do all day. So we're really excited, and I'm told that we're going to have people join us from the great state of Texas today. So our influence is expanding here. So we realize that this is maybe a little bit of a sensitive issue for some people, but our goal is only to discuss some factual current policies and, just get a preliminary conversation out there and information. Much like we did with the PPP loans, we feel like there are increased audits that are coming. We've already seen an uptick at our firm over the past couple months, and we'll show some of the stats there. So it's the same as the PPP and the ERC. We're just looking to get out that preliminary conversation to our client base and others, and just have them come in, at a higher level if we do have to follow up on conversations and stuff. So, excuse me, we'll just keep that. That's our goal for today. So. Just something to keep in mind real quick, we're largely focusing on IRS today because that's what's in the news. That's the big headline grabber. But audits can come from different entities and other organizations. So state, local, other entities and departments as well. For time's sake, I'm not going to go into it, but Pennsylvania currently has a audit program just for restaurants. So if you're joining us today and you have a restaurant, we can follow up on that conversation offline. I can tell you a little bit about it because I'm going through it right now. We're actually one of the first ones that are being audited under this program. So I know a little bit about it, sort of being the guinea pig with the Department of Revenue. They've somewhat been fairly decent and open with me on that. So again, if you have a restaurant and you want to follow up, I would encourage you to do that offline. And the other thing just overall is, the exact wording in the law is gentler, but you're guilty until proven innocent in any exam, really. The terminology and the softness is the burden of proof lies on the taxpayer, and that kind of makes a little bit excuse me, that kind of makes a little bit of sense in that you have to prove the deduction that you've taken, right? So again, we're going to go over what that looks like today a little bit, because we want you to have that legality of taking that deduction, if it's going to be looked at. But again, tax laws are not often black and white. There is some gray areas, and, examiners have, I've said this before, to other clients, but they really do kind of have the power of God. They can take any position they want on any issue, and it can be a very strained position, and it can be just flat out incorrect. I'm sure I'll get to it in some of the war stories maybe we'll tell coming up, but sometimes knowingly incorrect. I had a sales tax audit a number of years ago where, the auditor and I were sitting at a table looking at each other, and she knew she was wrong. She knew I knew she was wrong. And she just kind of smiled at me because she knew I wasn't really going to pursue or do anything about. It wasn't a major issue, but nonetheless, it was incorrect what she was doing. And, again, we both knew it, and, just kind of had to, I went over it with my client, and they're like, yeah, you just got to leave it go. I'm like, okay, well, I'm a little bit more black and white and principled, but, again, it wasn't a major issue, but again, we'll talk about examiners, a little bit as well. So current state of the IRS, just really quickly, in October of 2022, it was announced that they had started to hire, made progress on these new hiring positions. So they, in October of 22, you'll see, I believe we have a little bit of a graph on this later, but they've hired 4,000 and 1,000, for filing season. But we're all familiar with the current backlog of the IRS, then the service levels. So it was still reported that, they still had 9 million individual and business returns, as compared to 7 million at the same time in 21. So they're getting a little bit further behind even. So hopefully part of this hiring process, is going to go towards that, but we'll see. They had 250,000 of unprocessed 941 returns. That's to file your employee retention credits. And then 4.5 million pieces of correspondence. So letters, notices, things like that. So this comes right out of the Treasury Inspector General, who oversees the IRS Department of Treasury. And you can see here, so they had, individual returns that their backlog, business returns, and they had a goal and, estimate to reach the goal. And you can see this is the October report still. So on individual returns, they're on process to get those caught up by December of this month. Now, nothing has come out data-wise yet, but you can see business returns are kind of even, error resolution, they're kind of even, and then they're not doing so well in these areas here. So also, these are those 4.5 million approximately pieces of correspondence, and they're not doing so well here. So of 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 9 categories, they're doing well in one. So hopefully things will get better. But again, that's kind of what's going on at the IRS, and we all know that. But again, just to kind of reiterate it and put some data on it and stuff. Also going on at the IRS is, hopefully you're all familiar with the employee retention credit, but this is potentially the largest tax scam in history for fraudulent returns that are being filed. You all hear the commercials on the radio and on the TV, and hey, I had employment through the pandemic, and I can get up to $27,000 per employee, and they make it sound really easy, and you qualify and everything like that. And that is basically what the law is, but there are qualifiers and that you have to meet. There are wage allocations that you have to meet with PPP loans and stuff like that. But, and with anything, free money comes out the fraud. So there's a lot of ERC mills that have popped up. Again, they've identified the fraud, just the fraud, at possibly $2 trillion. So the IRS is ramping up the audit project on these employee retention credit returns, and they're basically pulling 90% of the exam staff to focus on this. So this is a huge, huge issue. And they've also developed an anonymous reporting avenue for the ERC mills abuse. So, they want to hear about these things. And then one last reminder, I keep preaching this, but the credit needs to be claimed against the wages that generated the credit. So if you had a credit for 2020, you have to report that credit on your 2020 return. Even if you filed amended tax returns to claim the credit in 21, you have to go back and amend your 2020 returns. And I don't think a lot of accountants did that. In fact, I know. I just know. So there's going to be a lot of audits in this area. We're going to see a lot, we'll see how it all pans out. We actually, I'm not sure if Steve will go into this, but we actually just had an IRS examiner in our office yesterday on this issue. And, I'll toot our own horn as a firm a little bit, but she was really, really impressed with the work we did. So we feel good about that going forward. So, so with that, I'll let Steve take a turn here, and we'll talk about some of the laws going into the IRS and these increased audits here. So, Steve, you want to take it?
All right, Brent, thank you, and good morning, everyone. Glad you're all with us. And just some goals that I want to share with you for the webinar is just to inform and educate you about the policies that are currently in place, and also dispel some myths that are out there in the news media about some of these bills. Some things to do to hopefully avoid that dreaded IRS audit, and what you should do if you do receive that IRS audit notice. Give you some stories that Brent and I have gone through over our history. We probably have between us probably 70 years of experience, and it's amazing in all that time. I can count on probably both hands the number of traditional audits I've gone through in that time. But needless to say, they can be certainly very frustrating at the time for taxpayers to go through all that work. And hopefully we can add a little humor as we're going through, as much humor as accountants have. I know we'll try to add a little bit to make it take a little bit of the edge off of a very serious subject. So the Inflation Reduction Act was a bill passed this past year. August 16th, 2022, and it's largely a non-tax bill. And we've actually, this is one of the first years that we really haven't had a tax bill come through in the last probably 10 years. So what I want to do right now is just read a little bit of background as to what this bill is. And this comes directly from the Treasury Inspector General of Tax Administration. Brent had just mentioned that TIGTA initials earlier. And so just so you know where this wording is coming from, it's a direct quote from a report that was just issued January 12th of 2023 by that TIGTA organization. So on August 16th, 2022, President Biden signed the Inflation Reduction Act of 2022 into law, marking one of the largest investments in clean energy in U.S. history. So even, the Treasury Inspector General acknowledges that it's not a tax bill, but included in the bill, the Inflation Reduction Act includes almost $80 billion in funding for the IRS. And that funding is authorized to go through September 30, 2031. So on your slide in front of you, the bottom two dates are highlighted, and that's a typo. So it should be 9/30/2031 for both of the bottom two. But so the funding, as you can see, is $3.18 billion for taxpayer services, $45.637 billion for enforcement, $25 billion for operations, and $4.7 billion for business systems modernization. And then there's like 15 million included for designing a free e-file system. So you can see this next slide and how those funds are included on top of the funds that are already budgeted. So you can see the enforcement budget of was like 66 billion, and the 45 is added on top. So that's clearly the largest increase in the funding is for enforcement. And operations support, so this is the customer service representatives and so on, which which we really need. We've gone through a period of time where we try to get a hold of someone at the IRS and nobody answers the phone. We get hung up on, so it's really been frustrating. So as we're jumping to the next slide, 87,000 new full-time equivalents. So where did that number come from? Many, I think this was currently, a big news media got their facts completely wrong as to where these numbers were coming from. They reported it as though it came out of the Inflation Reduction Act, when actually it came from report by the Treasury back in almost a year and 4 months prior to the passing of the Inflation Reduction Act. And that was a report on the American Families Tax Compliance Agenda. And so in that report, it had a lot of the numbers that almost matched up to what's in the Inflation Reduction Act. But that was the report where the 87,000 agents were mentioned. So that report gave a lot of information as to compliance and the lack thereof, with taxpayers complying with the laws. So I just want to read directly from that report. I'm not going to read very much today, but this I did want to read. So the magnitude of the tax gap means that compliance initiatives have the potential to raise substantial revenue. While roughly 99% of taxes due on wages are paid to the Internal Revenue Service, compliance on less visible sources of income is estimated to be just 45%. So in that report, they projected the tax gap is currently $600 billion and will rise to about 7 trillion over the course of the next decade if left unaddressed. So that's where all these new policies are coming from, is from that report. So as you can see, or you can hear what I read, that compliance with wages and those things that are reported to the IRS are almost 99%. So there's not much difference there, but it's those things that, in small businesses, Schedule Cs, compliance is really low. So that's where they're looking to build on the increased audits and enforcement of the policies. Okay. I think you can go on to the next one, Brent. So this little slide here shows the full-time equivalence of the IRS over the past few years, starting in 2012 through 2021. And this comes directly from the IRS data book that publishes a lot of this information. So in 2012, they had 90,000 employees, and there's no specific date there, but it's 2019 and 2020. The numbers dropped below 75,000, and then back up this past in 2021, just under 80,000. So that's where the employee number is at currently. They've increased maybe a few thousand over the past year, but it's still close to that 80,000 number. And in one of the reports that I read from Bloomberg, which is a tax reporting agency and research, we use a lot of their research material. They expect that over the next 10 years that there's going to be retirements and reduction in IRS employees of 50,000. So when they talk about 87,000 new agents or 80,000, whatever the number is, that's including replacing those that have retired and changed jobs and all that. So, all right. So one of the other bills that just passed at the end of the year, again, was it was the omnibus bill passed December 2022, and that was basically to fund the government. And included in that bill was a $275 million cut for the IRS for the coming year. So, but that's the normal budget. The Inflation Reduction Act increase is still in place over the next 10 years. One piece of other information on that last slide is that many of us accountants were expecting them to include tax extenders that they normally do at the end of the year. This year, they did not include those tax extenders. So that's going to make for an interesting tax season for us, because some of the things that normally got extended, like research and development credits, they weren't in that bill. So they haven't been extended. So we don't know what their IRS is going to do with that. But anyway, that's just a little tidbit there. This one, I'm not going to spend much time. It's not current policy, but there was some, rumblings in the House that they were going to abolish the IRS. Anyway, so we'll just skip on to that. That's, nothing current in policy right now. So we don't need to spend any more time on that. Okay, this is information that the IRS puts out from their 2020 data book. And this is just helpful so that you can see the number of audits in 2019 and 2020 over the types of tax returns that were filed. Personal tax returns at 1040s. As you can see, there was a huge drop in 2020. So we all know that was, COVID was in there, and that's the reason the IRS was basically shut down. So the numbers dropped significantly in 2020. But even, prior to that, they were only auditing 0.4% of all 1040s that were filed. And then the other returns, C Corps, S Corps, partnerships, very low numbers that are audited in that area. Estate tax, 706 forms, that number is higher. And technically, any estate tax return that is filed is really audited. It's more of a kind of a desk audit, because that's a specialized area, and the IRS attorneys that they have on staff will review every single one of those returns that are filed. So the number that's provided there would be, after a desk audit, ones that were selected to go out and do a field audit but anyway, that's another side story there. We can go to the next one, Brent, just kind of skip through. Again, these are numbers for 2020. Oh, this slide. Okay, what this slide is really showing us here is, typically in the past, when we think as accountants, when we think of audits, we think of the field exam column. So they're either audits where we would go to the IRS office, or the IRS would come to our office or a taxpayer's business. But in the past number of years, they've been switching to correspondence exams. So a lot of they'll consider, when they send out a notice that says, Mr. Taxpayer, you forgot to include a 1099 on your tax return for $1,000, they consider that a correspondence exam audit. So in that number and in this percentage are letters that go out to the clients, taxpayers that are asking for additional information. So these percentages are really a lot lower if you would pull out the correspondence exams. All right. I think that's all we need to cover there, Brent.
Okay. And yeah, on this slide, let's see if I can do this live here, but we just wanted to say, you know, this IRS data book stuff is right on the IRS website. So if you go up to their search bar and just put in, you know, IRS data book, realize this might be a little bit small, but you have all kinds of tables here, you know, and part of it is compliance here. So you can see I pulled table 18 and 20 here, I think. And let me see if we can do this live. I'm going to switch real quick. Not happening. Let's get back to my pointer. Bring up Excel. You can export these to Excel. And then I want to share the Excel book. So just looking at real quick, and again, real quick. So these are exams that were closed in fiscal year 21. So as of 9/30/21, government runs 10/1 to 9/30. So you can see here there was 659,000 individual exams that were closed. Now we hear a lot about the 400,000 limit. The IRS data is on 500,000, 2 to 5 here. So take this with a little bit of a grain of salt or understanding, but of the 659,000, 636,000 were below 500,000. And then above 500,000 to 10 million or more, only, you know, 22,000 exams were closed. So that kind of gives you an idea of where they're spending their time. And they sort of have to, because if we look at total, so these are the total number of returns that were filed for 2021. So 164 million returns that were filed. Of them, 162 million were under 500,000 of adjusted gross income. So only 2 million, 1.8 million were above the 500,000 mark. So they're going to spend their time, you know, again, maybe getting some of these up to historical levels and stuff. This one's interesting. These are returns that were closed that had refunds. So of individual returns, you can see 17,000 were closed with resulting in refunds. 13,000 were below 500, and then, you know, 4,000 or so were 500 and above. But what's really interesting here is look at these refunds of that group here. So again, we're going to have to see, this is kind of the baseline, 2021. So we're going to have to see where, you know, the data goes, and we can tell right from their website, right from that source, you know, where they're spending their time. So I'm going to go back and share the PowerPoint presentation, and I think we should be back on our way. So Steve, you want to tell them what happens when they file a return?
Okay, so yeah, so the audit process actually really begins when your return is filed and it's run through the IRS computers. So the IRS scores each return based on some top secret process. They use income, deductions, location of your home, family size, all kinds of things go into this this first score called the discriminant income function score. It's called a DIF score. And so the higher the score after it's run through the computer, the higher the potential for audit of your return. Once it goes, once they're scored, then they'll, there's a process that the IRS goes through, and would be, if it looks like it should be audited, they'll then send it over to a manager to look through the return and then make a final, assessment of whether it should be audited. There's also another scoring that they go through. It's called a total positive income score. It's TPI, and this extracts numbers from your return, only positive values. So it pulls out, negative numbers, like if you had a business loss from one business and positive one, it'll pull out the negative one that offset the positive. So it relies less on the adjusted gross income that way. And that's another scoring method that the IRS has to look at your returns. Go ahead, Brent, you can go to the next one. So then again, how are returns selected for an audit? Based on the computer scoring that we just went over. If there's any tax avoidance transactions that are picked up on when the returns are being looked at the IRS office. Information matching, as I mentioned before, you didn't report a 1099 that was reported to the IRS. That could, cause some sort of an audit, whether it's a correspondence type of letter, or if it could result in something else. Related exams. So if, previously a taxpayer was audited, that might jump them up to a higher percentage of the, IRS looking at their return again. Or if they had a related business that was audited, that could also, increase the likelihood that their personal return is going to be audited. Some other items to point out here: your return could be audited based on your tax return preparer. So if you have a return preparer that has had a number of audits in the past, especially if they're on kind of sketchy things, that could cause your return to be selected for audit. Different, market segments that you're in, foreign taxpayers, compliance projects. Sometimes returns are audited to make sure that there's a certain compliance. In the years ago, there was a really detailed audit that the IRS would go through, and it was like a line by line. On each line of the tax return, they would want to make sure that taxpayers are complying with that line on the return. So it's really detailed, and they would look at everything. And then it, could be totally random. All right, next page, Brent.
Yeah, I just want to jump in just for a second.
Sure.
We have good news in that we're gaining participants as we're going through, and we have really good news. We have no questions yet, so people are listening fast enough, and we're doing a great job explaining it apparently. But so I do want to just comment real quick here. Related exams here, there's a lot of cash transactions that happen between businesses. So I always explain to my businesses, if you're doing cash, either paying or receiving, your exam risk is not just you, it's whoever you're transacting cash with. Because, if you're, receiving cash, let's say, and then this is, this could be caught a couple different ways, but if you're receiving cash for something somebody's buying from you, they're not foregoing the deduction. So if they get audited and that examiner learns that, hey, they're paying this business cash because they didn't want to receive a check or, some kind of record, well, you're getting audited next. And that's what related exams are. And tax avoidance systems, if they find, years ago, there were court cases, one guy, had his, his organization's record subpoenaed, and they got all the members of the organization, and they went and audited all those people that belong to that organization. So, there's outside risk that sometimes we, clients don't think about or realize. So just keep that in mind. It's not just what you're doing, it's what other people are doing as well. So go ahead, Steve.
And back to your point on the cash, Brent, we did get a reprieve from the 1099-K reporting this year. The IRS had wanted any transaction of $600 or more by like an organization like Venmo or PayPal to have all those transactions reported. It came late in the year, the reprieve on that. So many of those companies may have already had the reporting in place for that. So don't be surprised if we see some of those come out this year for those that are $600. The old amount was $20,000. So that's where, the IRS is trying to get all of those, the compliance, as I mentioned earlier, with, W-2s and 1099s. They know the compliance is high with those types of things. It's the cash. So they're trying to get more reporting on the cash. But anyway, so there's still a chance that we could have taxpayers that receive 1099-Ks for $600 this year. And then we're going to have to figure out how we handle them on the tax return. All right, so let's see, types of audits. This is me also. So I think I mentioned on the one slide back when I was looking at, the correspondence and the office audits, field audits. This kind of just goes over those different types of audits. So the no IRS contact audit is, you might you get a letter from the IRS that says you forgot to report something. So they, letter comes out to the taxpayer, and taxpayer has to respond as to why they didn't report it, or they, agree that they missed it, and get back to the IRS. Correspondence is pretty much the same type of thing. You might have a phone call. Oh, let me see. I didn't get to that point yet. It's coming up, but office audits, where you go to the IRS office and bring them, some information that they're asking for. So here I have a little story. This was my first, way back when I started, a few years after I, started, and I think it was the first year I had my CPA license. So I was able to go and represent a client on an audit. And so I think it was 1987, might have been 1988, but it was a long time ago. And I had this tax return I prepared for a sweet older lady, and she was moving out of her house into a nursing home, and she was a very charitable lady. Her husband died a few years ago, and really had no other relatives remaining. And so she decided that she wanted to donate her house to one of her favorite charities. And that's what she ended up doing. And I reported the donation on her tax return. And, sure enough, because the donation was so large compared to her income, she was previously a school teacher and, had a pension and all that, but she was going to have a contribution carryover for a number of years. Well, the IRS picked out her return and audited it. So that was my first audit. I went to the King of Prussia audit, or the IRS office, and back at that time there was no computers, so I had my two big briefcases that I carried with me with all the records, and everything was in place. She had the appraisal of the house and all that she needed to claim the deduction. So it was basically a formality. They wanted to make sure that it was a legitimate contribution, and it was. She had all the documentation, and so there was a no change on her tax return. So anyway, that was my very first audit. I was a little nervous. I will have to admit, I had, was surprised that my boss told me to go by myself. I had never gone through an audit at that time, but it was a good experience. Field audits are when the IRS comes out either to our office if we're representing a taxpayer, or they go out to the taxpayer's business or their home, and they meet with the representative at the location. All right. So general steps if the IRS wants to come out and do a field audit. So the first thing is they'll give you a notification by mail, and mail is underlined. Please be aware that there's a lot of scams out there right now. The IRS will never send an email. They will never give you a phone call initially. They will never send a text message. So just be aware that anything other than mail is a scam. and so do not respond to it. I think I would move one bullet point around here. They would included with that notification by mail is the information document request, the IDR, which is the fourth bullet point. And that's form 4564. They'll say what they want to look at. And, as a experienced tax professional, we can look at that IDR and kind of get an idea of what the IRS agent is looking for specifically in the audit. If there's maybe it's a C corporation and the compensation of the officers is really high, you're gonna see that from that IDR request. And then they're gonna want to do a site visit. They're gonna want to interview the taxpayer or their representative. And I would suggest that, for all of our clients, we would generally want to handle that interview. But there's two pieces to that interview, and I would say the taxpayer interview from our perspective, what we would want to know is basically everything that the taxpayer can provide us, our client. We're going to want to, get into really understanding everything, because the IRS agent is going to have a lot of information that they get that we don't necessarily know. So we want to make sure that nothing's going to pop out that we're not aware of. If we're interviewing our client, we're going to try to really make sure we understand everything that's going on, so that the IRS agent isn't going to have any or want to have any need to speak to the taxpayer. Okay. I am going to mention, Brent said we weren't going to do any codes or anything, but the Internal Revenue Code 7521C prevents the compulsion of appearance of the taxpayer. So the taxpayer does not have to be interviewed by the IRS agent. So let's keep moving here. We're going to want to pick the place of the exam. Generally, we don't want the taxpayer or the IRS agent at the taxpayer's place of business. We don't, want them to be able to, overhear any employee conversations or anything that could give them any additional information other than, what they need to know. So IRS agent's going to go through his exam, and then he's going to come up with his findings, and you're going to have to go decide if you're going to want to close, if you're going to want to appeal based on his findings. So this is a very important slide for both the tax advisor and the client to be aware of. This was first, so you've all probably heard of the, attorney-client privilege. Well, there's a tax advisor client privilege, which came about back in 1998 through the IRS Restructuring Reform Act. And then it was codified by IRC 7525, and it's for federally authorized tax practitioners, which are CPAs, tax attorneys and enrolled agents. And, includes communication between the client and the client's representative, and it applies to any civil, non-criminal federal tax proceeding. So just to go a step further there, so here's where the importance of the interview with your client is so important, that you get all the information out there. If in your interview something comes up that you weren't aware of before that could potentially create a criminal tax proceeding, you want to immediately refer that to a tax attorney, and then they're going to have both the tax advisor. The tax advisor is going to have to sign a Covell letter that's going to protect them for privilege for criminal proceedings also. So you don't want the client to tell you too much in those cases. It's really serious at that point. All right, I think we're gonna go ahead to the next one.
Yeah, so Steve, I think we're going to camp out on a couple of these slides here. So don't hesitate to chime in, with your experiences. But I have quote unquote strategies and audit field work here. These are not absolutes. Each exam is different. To kind of play the doctor card, every exam's different, and it's going to have different issues, and have to handle it accordingly. But generally, if you have a operating corporation, partnership, a business that has multiple transactions per day, you're really going to want to work with a representative prior to the exam visit to organize the documents, identify issues, like Steve said, that you may need to be concerned about or just aware. So as the representative, discussing with the IRS, you're aware of that, and you can dance around it or address it, or again, handle it as you feel necessary. Steve also talked about scheduling a exam at a time and place convenient for you. Again, removing the examiner from the place of business. So again, it's disruptive. It's not a good look, to have an IRS exam agent at your place of business, and they're going to camp out for a week at least, I'm sure, depending, multiple days for sure, if not weeks. And again, they'll learn a lot by overhearing things. They could possibly see the number of transactions and form ideas and opinions and stuff like that. So you want to kind of remove that, keep them focused. Again, you're asking for proof of utilities. Here's the utility bills. Done. No, we don't have to, again, go into this idea of, you're going to get ideas from being there that then we have to address. Less is always more. Scope creep. Examiners love to kind of ask things outside of the years that are being examined, or bring in new issues potentially. So again, maybe physically removing them or directing conversation, keep them focused, is really a good idea. And again, less is more. So I'm not sure, Steve, we've always, in my audits, I've had the clients do the client interview, understanding they're not required to do that. But again, we generally want to work with the examiner, at least at first, right? I think you were going to go over this, but they're people, they have a job to do, and we want to be respectful, especially up front while we're kind of feeling each other out here. So I always consult my clients, if they're going through that interview process, that they don't really volunteer information. Okay. So we don't want 5-minute answers to questions. We just want the least amount as possible, keep it short, sweet, address their question and move on. So again, less is more.
Yeah, Brent, I'm just going to jump in here too. If it is if you do get the audit moved to, let's say, our office instead of the client's business, the auditor is going to want to, take a look around the business at least, so they're going to want to visit the business, and that's okay. There's nothing wrong with that. It's just, I would certainly make sure that I'm with the auditor at that point, going around, and taking him around the business, or him or her, as the case may be. And certainly they're, when they get to the business, if the owner of the business is there, I would introduce them. But yeah, personally, I don't have the auditor talk to the business owner, in my experience.
Excuse
me. And your comment, yes, your comment was very important on how you treat the IRS agent, because actually the IRS agent at that point is not just auditing the client, they're also auditing us as tax preparers, because if anything comes up, you treat them badly, that's going back, in the system, and you're going to have certainly have a mark against you. I do have a little story to add here. One of my audits was for it was for a gift tax return, and the gift tax reported a large gift of a business, so of privately held business. So it was a several $million gift of that business interest to one of the other family members. So anytime that happens, the business has to be valued to to report the gift. And values are done, like, since I prepared the gift tax return, I could not value that gift. So the business entity had valuation experts that valued the business, and it just so happened that that gift tax return, and if you go back and look at the numbers, there's not very many that are audited, but this one was audited because the business value was so high, and there was a number of gifts made during the year. And anyway, long story short, I'll try to keep it short. So that gift tax return is kind of the same as an estate tax return, is audited by an IRS attorney. That's all they do, is they're focused on estate and trust issues. And and sure enough, they wanted, so we had this audit going, and they wanted to, IRS attorney wanted to talk to the business valuation expert that my client, got the value for. And I was, I got a conference call set up, and the IRS agent was having issues with how that value was, some of the discounts that were taken, and the valuer started arguing with the IRS agent. If I could have reached through the phone and grabbed that guy, and just told him to stop, because all he was doing was hurting the case. So anyway, it worked out okay. They changed some of the numbers, but it didn't really have a dollar effect. But that was a case where the valuer was just, he was getting unduly upset because of the IRS agent questioning something that he had done. Anyway, that was kind of one of my little stories.
Yeah, just to finish the slide out, and I'll kind of go back with a few stories or experience of mine, but these last two, these are really, really important. So we went through the steps to the audit or the exam. So the IRS is going to issue their closing document, closing proposal to close, whatever conversation term we want to point to it. But legally, once they get to that point where they've issued the proposal to close, legally, they're done auditing. So you want to try and get to that point as soon as you can. And then subsequent to the exam, if necessary, if you're going to appeal, which we'll talk about in a little bit, but I always request copies. You can get copies of the examiner work papers and audit files. Now they're redacted. They have a few things redacted. So if the examiner is talking with her manage, inside baseball of, I think we could prosecute on these grounds because of this, that, and the other, that type of stuff will be redacted. But things from the client interview, which I'll talk about in a minute, other things just are not going to be redacted, and you can use that against them in appeals. So these last two, I think, are really, really important. So to kind of go back and share my stories here on this slide real quick, but scope creep, I had an exam that the examiner, it was that C Corp, and they were challenging the officer compensation. Like Steve said, it was, it had drastically gone up over a number of years, and they wanted to come in and reclassify some of that to dividends, which they'd have more tax. They would make the argument that it's not compensation, it's really dividends in disguise. That was the issue. So they asked for, I forget, prior to the first year of the exam that they were entitled to, they asked for a schedule of officer compensation, 3 or 5 year schedule, if I'm not mistaken. I forget the exact number, and really kind of talked about it or gave it some thought. We ended up giving the examiner that information because it's right on the corporate return that ultimately they would have had access to anyway. But, again, I don't know that he had a right to ask it from us, but I only gave it to him because ultimately, if he really wanted to push, he would have access to it anyway. And it would, again, not treating the examiner, difficult. If I was to be difficult, again, who knows what position they would take. Here, proposal to close. 2 examples here is And I know what you guys are going to think, and I swear it is this simple. We had a partnership. I had a partnership that was under exam. It was a husband and wife partnership. And the examiner took the position, and again, it's this simple. I know you're not going to believe this, but the examiner took the position that the husband and wife weren't people, and therefore you didn't have two people to make a partnership. Okay. Now, I ask questions like, if they're not people, what are they? And why are you adjusting a personal tax return to take this position? And obviously she didn't have answers. And maybe I argued that a little bit more than I should during the process, because I'm like, this cannot be real. But, you know, a good strategy would like, just let her get through, let her get the proposal to close, take that position, and I can appeal that very easy and win that, you know, instead of arguing. You know, another is, excuse me, actually, I'll talk about the subsequent to the exam. So a couple cases here, I've had two appeals. I had one appeal where the examiner took a position, wanted to charge self-employment tax on certain income that really was not self-employment income. And, you know, I got copies through the Freedom of Information Act. I got copies of the exam file, and lo and behold, the part of the client interview that she would have had to gather the information to do this was totally blank. So again, I won that appeal because I copied their exam file, their own exam file, and said, here, you've took this position, but you don't have any information to take that position. Okay. And then same thing, I have another appeal, again, where they're trying to charge penalties, and I went through the exam file, and again, the section that needed to, you know, be completed was blank. So I believe I'm going to win that appeal. Back to this proposal to close, we'll talk about it in the statute in a minute. And actually, I'm just going to go to the statute and we'll talk about it there. So statute of limitations is the IRS usually has 3 years from the due date of the return, or the date that the return is filed, whichever later, to assess additional tax. Okay, so this is not an absolute. There's, you know, they can extend that statute. There's different cases. I don't want to get into that for time's sake, but generally 3 years. All right. The way the service, the speed the service works, they're not going to be able to complete the exam, assess the tax, handle the appeals, and do all that within the statute timeframe. Okay. So I can almost guarantee you're going to be asked to extend the statute. All right. But you are not required to extend the statute, okay, or agree to their proposed date. You can come up with a shorter date if you so desire, or you can flat out refuse. All right. Generally, you don't want to refuse, but I'm going to talk in a second about an example I have currently. But you'll generally want to extend because you'll have additional time to submit the documents to, you know, for substantiation of your deductions. It keeps them from prematurely closing the exam and may affect appeals. All right. If you're in appeals, you definitely want to extend the exam statute because you're trying to lower your assessment if you're in appeals. So that's kind of almost as close to an absolute as you can get. All right. But not extending the statute can be useful if the examiner is just taking their good old time. Their case may not be fully developed, and thus it may end up being easier to defend in appeals. And again, that's on a case by case, you know, issue by issue basis. All right. It keeps them focused, prevents them from discovering other issues, and forces them to close it, which may be beneficial. So, all right. So my war story is I had a individual who got a exam notice right before COVID, probably 2020, right? If I have my dates right. And then everything shut down. And it literally sat for a year. Service showed back up. They wanted documents, and it just was, they weren't playing nice or quick or anything. We had given them all the documents in January or February, and then by, I'm going to say, the end of June, and I could be off, they wanted us to extend the statute. And I felt they had all the documents long enough, and I knew the issues. It was just generally kind of focused. It was an individual client. He had a Schedule C, and maybe 5 or 6 lines on the Schedule C were subject to change, maybe, if that many. So, and this was also a case where I didn't actually represent the client, again, because his return was fairly simple. He was fairly a detailed guy. We kind of took the position where he was going to handle the audit, the interview. It really was handing over receipts, and should have been that easy. And so he did his client interview. They, again, they were kind of not getting to things timely. So I said, you know what? I said, refuse to extend the statute. Okay. Sent him on his way. We talked about it. I don't want to downplay this. It's a big decision, and generally I would not do this, but sent him on his way. He calls back. He's like, boy, they weren't happy. Like, well, that's fine. And sure enough, they closed the exam. They kind of threw their hissy fit in that they disallowed every expense to its full extent, okay, on the Schedule C. And I'm like, okay, that's good. Now we can appeal. All right. So we forced them to get to that closing. Okay. Now, lo and behold, they came back, and they're like, and actually, I'm sorry. Then we extended the statute very expressly only for appeals. We said, we appeal your decision. Here's our written notice. We're extending the statute for appeals. Well, lo and behold, they kept doing audit field work, and they came up with additional issues. Okay. Long story short, told them they can't do this, but they went ahead and did it anyway. Again, these people do what they want. So we went to appeals. We're currently in appeals, and I have the appeal through, and any of those new issues that were raised got tossed out, because they legally couldn't audit or keep performing an exam after they issued a potential closing document. So I won that one. And again, this is the one where there's, blank questions on the questionnaire, and, I fully expect to win that appeal as well. But, I think if I work another 15 years, I may not have another case where I don't extend the statute. I'm not sure. But I'm sure Steve is sitting here in shock or dismay, potentially, but again, it's a case by case basis, and it just worked out for us in this case. It did what I needed it to do. So again, once you get into the proposal, they're boxed in. Then you can argue. They can't raise issues. They can't keep performing field work. They're done. Okay, and technically it needs to go to appeals at that point if you're going to appeal it. So a couple things. This is not an exhaustive list by any stretch, but these are pretty much absolutes. So what's the examiner going to do when they come out? They're always going to do at least 3 things. They're going to do a deposit analysis. If you have auto, they're going to reconstruct the auto logs, and they're going to try and match expenses claimed to a receipt generally in an income tax audit. Deposit analysis, very simple, right? So if you claim that you have, you know, whatever, $250,000 of income, they look at all your bank accounts, which they'll have access to, whether you like it or not. They look at all your bank accounts, and you have $280,000 of bank deposits. You better explain that difference of 30,000. Okay. So they're just going to look at your bank accounts. They're going to add up the deposits for the year, and they're going to see how that compares to what you reported on your return. Now, this goes really quickly. This goes for individual returns as well. All right. So I'm horrified because every time I go to the bank, they ask me if I want a balance, and I always say no, right? I'm an accountant. I know what my balance is. Okay. But the bank is asking me that just sends horror shivers down through me because people aren't keeping their records, right? So what goes into your account, right? Insurance refunds, people reimburse you for dinner, some of these Venmo payments that Steve's talking about, just all kinds of odds and ends that are not taxable income, are not wages, are not, you know, distributions from a business or anything like that. If you're an individual and you do not have clean bank records and know where your deposits are coming from, you get audited. They're going to do this deposit analysis. You're going to end up paying tax on insurance refunds, reimbursements for dinner, kids paying you for gas, whatever.
Gifts,
okay.
Gifts from
gifts.
Yeah.
They're going to do this bank deposit analysis, and they're going to charge you. They don't care. You can say it's not income. They don't care. You have to prove it. Again, the burden of proof is on you. All right. So, you know, I've ruined a lot of people's days here. I think we're going to start losing participants now, Steve. But the other thing that they're going to do is they're going to reconstruct auto logs. All right. And if it takes them 3 days to do so, that's what they're going to do for 3 days, because this is a very particular area of the law that they can disallow very, very easily the expense that's claimed. All right. In the lightning round, we talk about this a little bit, in the lightning round we have in the presentation. It doesn't look like we're going to get there because it's 25 after 11 already. But this is a big, big area. Okay. Low hanging fruit. And they're going to match expenses claimed to a receipt. I will say this, and I'll make it quick, but I cannot tell you how important this is. You need the receipt for the tax deduction. They can tell that you went to Costco by your bank account or credit card. They can tell you went to Staples by your bank account or credit card, but they cannot tell what you purchased. Okay. You can go to Costco to buy some business items. That's true, but you can also go to Costco to buy pants, groceries, all kinds of stuff. So if your bank account just says Costco $572, that is not going to get you the deduction. You need the receipt that comes out of that register for that. Okay. Very, very important.
Brent, I'll go a step further there, and sometimes the receipt itself is not enough. For example, meals. You take a business client out for a meal. On that receipt, you need to also add what the meal was for, the lunch, the dinner, what business you discussed, and you know, that needs to be added to the receipt in order to get the deduction. And
I think this is in the materials in the lightning round as well, if I'm not mistaken. Very, very important to pull that publication that we referenced from the IRS website. You can go there, pull that publication, and read that in terms of travel and entertainment for that. So I apologize, but we're really going to have to fly through here. But at the conclusion of the exam, you know, again, you're going to receive that closing document with a change or no change. If you're going to sign and conclude, you can pay, have the refund or whatever, or you can appeal. There's appeals, which I think Steve will talk about in a second, but there's two types, well, sort of two types. There's an offer and compromise, you know, but you're going to, again, have to extend the statute. So the offer and compromise is if you can't pay the full balance at one time. But the appeal process, again, I'm not sure if I'm going to steal from Steve's, but it's just a informal conversation with the manager, and then it goes to an appeals office. Again, that's very informal, if you will, before it would get to tax court or something like that. So, Steve, you want to run through, I think, these, but keep in mind we're 2 minutes out.
I mean, I think, Brent, I think I'm going to say, you covered it pretty well. It's going to be a decision that you come up with based on the conclusions of the audit, whether it's, you know, and I think actually, you know, when you have your conversation with your client and discuss the issues, you're going to know, you know, unless there was something that you weren't aware of, you're going to know whether the IRS has, you know, has a case. So if they're, all that to say is, I think you'll kind of know ahead of a time whether you're going to need to appeal it or not, you know. But yeah, you have these two options: the appeal or offer and compromise. And I think let's move on to the items that can cause an audit. Okay. So just real quick, I think a very important concept here is, and one of my, I call him my mentor, Jack Sargent, who he's, you know, going back years, he's trained a lot of CPAs, created a lot of courses. I've, you know, over the years, you know, I got to know him, and you know, it was pretty interesting that a small firm like ours could have a speaker that speaks all over the country. He'd come back before Christmas, and, you know, he'd just have an audience of, you know, several hundred CPAs, and he would come to our office in Telford with, you know, our 15 CPAs and do a special course just for us. But anyway, one thing that has always stuck with me over the years, and one thing that he said is, tax is about form over substance. So in other words, you can, if you have the right form, you will win. If even many times people think if you have all the receipts, that's enough. And that's not necessarily the case. So for example, one important thing is like S corps, you have to have basis to be able to take a loss. So in order to get basis, you know, a lot of times you'll loan money into the corporation, the shareholder loans money, and then that gives them basis. So sometimes we forget that that basis has to be at risk basis. So we don't always ask where the money came from. So if it came from a family member, he doesn't get at risk basis. So if we don't know that, the IRS agent picks that up on an audit, you know, that could cause an issue. But anyway, that's kind of a little side note. But high contributions, I mentioned my first audit experience, contributions were high. I have a number, you know, many clients that are very generous and give a lot of contributions. It's not as big of an issue anymore because the IRS you know, gave us a higher standard deduction than you know, we had over the years. But if I see the contributions are really high, I'm going to attach contribution receipts to the tax return so that I know that they're not going to, you know, look at that issue. They'll have everything that they need. High auto expenses, Brent mentioned, you know, you got to have auto logs. You got to, you know, you can't just, and taking 100% of a business auto on a business is you know, an auto, yeah, is an IRS audit trigger. We mentioned the high officer compensation on one of our C Corps that created an audit. You know, luckily, you know, Brent and I looked at that ahead of time and we got everything, made sure everything was in shape. That was a no change audit. Low officer compensation on S Corps. That's you know, one of the things that the IRS agents are going to be looking at. You know, that's where they know they're missing a lot of dollars there. Foreign income or assets, you know, high probability to, you know, create an audit because there's so many different issues with that. Like, for example, normally if you get a gift of $16,000 this year, there's no gift tax return filing. But if you get a gift from a foreign person, you know, you have a relative in Italy and you get a gift, you have to report that gift on a form 3520. So if you don't ever report that, the statute stays open. You don't have a 6-year close on that. So IRS can come back and audit that at any time. Schedule C businesses, higher audit risk, certainly, than not having a business on your personal tax return. The reason Schedule Cs are higher risk is because on your personal return, you don't have to report a balance sheet or anything else like you do on S Corps or partnerships. So there's a little, you know, it's a little bit looser. So the IRS, you know, is going to look harder at the Schedule C or single member LLC businesses more so than they do S Corps or partnerships, actually. And then Brent has highlighted the other bullet points in the lightning round. Yeah, you know, we knew we were going to have a lot of trouble getting through this. We probably could have talked all morning about these items, but we knew if we would have advertised it for a 2-hour webinar, we probably would have had not as many of you sign up for it. But anyway, hopefully, you know, we got through a lot of this information and gave you some good ideas. QuickBooks has become a big issue. You know, the IRS agents, if they're coming out for an audit, they're going to start routinely asking for your QuickBooks file. Do you have to give them the file? Technically, yes, you do. They're entitled to your books and records. I would say, you know, this is what you have to take a look at with your tax representative. Do I need to give them the QuickBooks file, or can I print out my whole general ledger, or, you know, see what the IRS agent is going to accept. One good piece of advice, though, is if you do have to give them QuickBooks files, give them a period file. So limit them to the year that's under audit, so they don't have open access to all of your information on the QuickBooks file. One article I was reading was to even make a copy after each year, copy that file and call it potential IRS exam file and close out that year and save that year to a separate file. Yeah, and back to, you know, if you give them the whole QuickBooks file, and then later you try to assert privilege to some information that's on that file, you're going to have a hard time if they already had access to it and you gave it to them voluntarily.
Okay, so I'll take 30 seconds, wrap up. The big questions that we always get, how long do we have to keep our records for? These two slides are right off the IRS website. So, you know, keep records for 3 years unless 4, 5, or 6 apply. Okay, so you can read that and see, you know, and let us know if there's any questions on that. But again, this is right off the IRS website. And then also what should we do for non-tax purposes? Again, right off the IRS website. So, you know, let us know if you have any questions on that. You know, how much does an exam cost? Spoiler alert, they're expensive, even in the smoothest of best of cases. So we're talking, you know, quite a few thousands of dollars. So do yourself a favor, have good books and records, because you don't want to pay to have the exam and then, you know, pay tax on top of it. And they can take a while, like we were explaining. Hopefully you got a flavor for that in the, you know, the war stories. Again, this lightning round, I didn't think we were going to get to, but this has all the expansion on that one slide. So again, that IRS publication is in here. It talks about, you know, the auto log and what's required, meals and stuff like that. So, you know, go through there. Again, we don't have anybody with any questions, so I think we did a good job, Steve, or nobody cares. I'm not sure which. We'll have to figure it out. But we appreciate your.
You can always reach out to us with any questions.
Yep.
Feel free to do that.
Yep. And, you know, again, we appreciate you being here. You know, we do this for free, but, you know, we just kind of softly ask if you could leave us a review somewhere along the way that's positive. We'd appreciate it. And, you know, while we have everybody's attention at the end here, we are hiring. So what's interesting is we're not hiring a tax position, so no tax experience necessary, 40 hours a week, accounting position. So, you know, from a car dealership or, you know, a controller position, we'd be interested in talking to that person. So if you know anybody that's sort of in a, I don't want to say a career change, but, you know, shifting for whatever reason, we'd be interested in talking to them. So without going into it too much. So I think for that, Steve, anything else? I appreciate everybody being here. And again, reach out with any questions.
Brent, real quick, copies of recordings. I
Yep.
see something coming through.
Oh yeah, they'll be posted on the news and events section of our website and our YouTube channel.
Okay.
Okay. All right. Thank you, everybody. Appreciate it. Sorry for going a couple minutes over, but hopefully we served our purpose and got some good information out. So thank you.
Thank you.